Hello and welcome back to another video. My name is Connor and today I have a quick one for you, but I want to take a look at the latest data, housing data from the HM Land Registry here in the UK. So it's the latest house price data release basically. Now I've got notes on my screen which is literally just here, so if you see me flicking over, that's why. So without further ado, let's jump into it. Okay, so in England, the average house price has increased by 11.9% to £299,000 over the year to April. Wales sits at 212,000, which is a 16.2% increase. Scotland is at 188,000, which is a 16.2% increase as well. And Northern Ireland has increased to 165,000, which is a 10.4% increase. Now, £299,000, I think we'll all agree, is a hefty sum to think of for an average house price, okay? Now, obviously, in certain parts of the UK, it's going to be higher, it's going to be lower, that's obvious. But as an average, £299,000, wow. Now, let's take a look, okay, at the average person living in England and the average UK salary, which is £31,772, and how they're supposed to afford this average home price of £299,000, okay? Now, banks normally lend up to 4.5 times your annual salary. So if we take the average UK salary of £31,772 and times that by 4.5, that gives us a total loan of £142,974. That means you would need a deposit of £156 and 26p. Pretty reasonable, I think you'd all agree. Nothing wrong with that whatsoever. Now, this doesn't, of course, take into account any bills or existing credit you already have, which can significantly impact how much a bank will lend you. So actually, in reality, it could be that the bank will only lend you £120,000. You know, it's kind of wild where we're sitting right now. Although this report points to a strong housing market and a market that is going to continue going up, this data is lagging. So this data is a report for April, which in the current economic environment is a lifetime ago. It's a long time ago. A lot's happened. Since April, we've had a base rate increase, we've got a cost of living crisis, we've had an ongoing war with Ukraine, and finally there are real fears of recession starting to kick in. So although the above figures show a resilient property market, the true impact of all these negative catalysts are really yet to be seen. And despite the HMRC saying the housing market is showing absolutely no signs of a slowdown, personally, I don't believe this to be true. I'm not suggesting we're going to see a crash where prices fall 30 to 40%, but taking everything into account, taking all those negative catalysts into account, I think it's inevitable and perfectly reasonable to expect to see a slowdown in the housing market with price decreases anywhere from 10 to 25%. 25% I think would be on the high end. That's just my personal opinion. So this kind of begs the question, what should we do in this market? What should you do with your money in this market? Should you buy? Should you wait? Well, this is not financial advice. I can't give financial advice, but I'm a big believer in buying property and waiting rather than waiting to buy property. The trouble with waiting to buy property is you always try and anticipate a crash and never end up actually buying a property. And then you always look back and think, oh, I wish I bought a property at X number of years ago. So this then begs the question, how do I protect myself against falling house prices and increased interest rates? So, number one, you need to find and buy a property that needs some work doing or that is below market value. And below market value normally means because it needs some work doing, or there's some things that scare new or potential, or first time buyers because it looks like a lot of work, when actually, because you've done the research, you know that it just needs a plaster and a new paint and some new flooring, which in the grand scheme of things doesn't actually cost that much. Especially if you can do a lot of the work yourself. If you can lay new flooring yourself, you'll save yourself thousands of pounds. Now, another way to protect yourself is to make sure that you stress test your properties at a higher interest rate. So if you've been stress testing cash flow and property at 3 to 4%, start testing these properties that you're looking at 6+% interest rates, and that way you know if mortgage rates go up to 6, 7, 8, 9, 10%, which I think is unlikely, but if they do go up there, then you've stress tested your property and you know that you're okay, it's going to cash flow up until a certain interest rate. This way, this is really the only way to know if a deal will make sense in higher interest rate environments. Which, will we see that kind of interest rate? Personally, I think no. But we could start to see the 3 to 4%. 3 to 4%. We could quite easily start to see that 5 to 6 come in. Especially if you're a buy-to-let investor who is trying to put down 20% instead of 25%, then it would be more than likely that you'll start to see slightly higher interest rates. Beyond this, my view is earn as much money as you can, whether that be by learning something new and working as a freelancer, and save as much cash as you can. Just build a cash pile and get ready to buy property. So that's really it for this video. As soon as any more data comes out, especially some more up-to-date data, I'm going to make sure to get a video out for you guys. But thanks for watching, and until next time, have a good one.